Hello, and welcome to the Retire to a Life You Love podcast with your host, Michelle Gessner. I'm Wendy McConnell. Hi, Michelle. How's your summer going?
You know, it's so hot in Houston. So when you ask how the summer's going, we just pretty much stay inside during the summer. Yeah.
Heat in Houston. It's a novel idea. I know.
Yeah. Heat and humidity and mosquitoes.
All
Yeah.
this fun stuff that comes with it.
Yes.
So we're going to be talking about annuities today, right?
Yeah. I thought we would get into some technical stuff. I'm hoping with this episode to educate our listeners about annuities. I get asked questions about annuities, and I know there's a lot of confusion and misinformation about annuities. So I was hoping to kind of break it down and for our listeners, this is an episode where we're going to somewhat get into the weeds. I'm going to try to keep it high level and purely educational, but of course, I'll probably throw in a thought or two, an opinion or two, as we go through.
Okay, so I don't really know a lot about annuities. I just really hear that, it's something you should stay away from.
Yeah, because there is an abuse of annuities by overzealous salespeople. So yeah, they can be a trap for people. You need to know what you're doing. Your advisor or whoever you're working with needs to know what they're doing. But here's the thing. They're not all bad. It's everything in moderation. So that's kind of what I want to talk about today.
Now, am I wrong when I think of annuity? I think of the lottery, and you're like, you get to pick the cash option or an annuity.
No, you're not wrong, because an annuity, what is an annuity? Let's start with that. An annuity is typically a series of payments to you from the provider, from the insurance company. In fact, Social Security is an annuity. You paid into the system all these years. And then when you file for Social Security, the government starts paying you over the years through up until the time that you pass. And then when you pass, if you're married, your spouse gets some of the benefits. So that's an annuity. Same with a pension.
Okay. So there's a couple of different kinds of annuities, and we're going to go over those today.
Yes, I'd like to kind of cover the different types of annuities. And as I do that, hopefully our listeners will begin to understand that they're not all the same and what the purpose is of each type.
Okay, so let's get started.
All right. So I want to start with just overall what is the same with all these different types of annuities. So overall, when you put your money into an annuity, the money becomes tax deferred. And what I mean by that is any interest you might earn is going to not land on your tax return until you take the money out. So that's the way it is with IRAs, right? When you have an IRA and you earn growth and interest, you don't get taxed on that until you take a withdrawal. That's what annuities do to regular money. So if you're funding an annuity with IRA money, nothing's going to change. If you're funding an annuity with regular money, regular non-IRA money, then the tax benefit is that interest or growth does not end up on your tax return each year until you start taking withdrawals. So I just wanted to put that out there.
So are you in essence being double taxed then if you're putting regular money into an annuity?
No, because if you're putting regular money into an annuity, your regular money, if it earns a rate of return, let's say you put it in a CD instead. Well, in that CD, it doesn't enjoy the same tax deferred phenomenon that I'm describing. So as you earn interest on your CD, that interest is going to come to you in the form of a 1099, and you're going to get that. That's going to land on your tax return for the appropriate year, and you're being taxed as you go. With an annuity, that same growth that you might be earning, let's say it's the same rate of return, it's just going to stay off your tax return. There is no 1099 until you take that money out. So it's not double taxed. There are a few other little tax things to know, but I don't want to get too far down that track right now.
Okay. So what should we be looking for?
All right. So the thing about the tax benefit is that if you're trying to turn your regular money into tax deferred money, an annuity can be a benefit. Just know that you are going to pay tax on that growth, but it's going to be when you take the money out. So if you're in a high tax bracket now and you expect to be in a low tax bracket later when you need to take that money out, that could be a benefit. And you could be interested in that feature of all annuities. All right. So what kinds of annuities are out there, and what should you know about the differences? Let's start there. So the first one I want to talk about is what's called a fixed annuity. And that one is the simplest of the types of annuities. So a fixed annuity is simply an insurance company takes your money, whatever lump sum it is, and in return, they pay you a fixed rate of return that you know upfront, and it's guaranteed. Now, it can be over a series of years. It can be just 1 year, whatever that term is. You've already been told that up front. You already know what that is. So you have a guaranteed interest rate and a guaranteed term. That interest is paid to you at the end of the term or each year, but it's not. It's credited to you. But if you're not taking it out, it is not landing on your tax return. It is not being taxed. And then when the term is over, you can either renew it or you can take your money and go somewhere else. There will be a surrender charge, a penalty, if you take it out prior to the agreed upon fixed term that you knew about in the beginning.
When it almost sounds like you're a bank and you're loaning your money, and this is the return that you're going to get is like the interest.
Yeah, so it is very much like a CD. So a fixed annuity is very similar to a CD, but here's the difference. A CD is issued by a bank, and a fixed annuity is issued by an insurance company. A bank often will provide you with FDIC coverage on that money that you're putting in that CD. An insurance company does not provide FDIC. The money is only as good as the guarantee by the insurance company that they're going to stay in business. Now, the insurance company, that's why it's very important to find one that has high ratings. And there are independent ratings companies that issue a rating of the solvency, financial stability of that insurance company. So those are pretty much the differences. But yeah, a fixed annuity, I like to think of it as kind of like a CD. It would be in place of. And there's a type of fixed annuity called a multi-year guaranteed annuity, MYGA, or MYGA is what people like to say. That just means, hey, it's several years, but it's a fixed annuity. And yes, like a CD has penalty for early withdrawal. So does an annuity, a fixed annuity. So you'll know what those are up front as well. And there should be no fees on fixed annuities.
Basically, the benefit is you're guaranteed a return.
Yeah, and you're guaranteed a return by a CD. So if you're shopping for what to put your money in and you want a guarantee, you'd be looking at CDs. You should also look at fixed annuities and understand that the main difference is one's by an insurance company, one's by a bank. One has no taxation happening. That's the fixed annuity. Whereas a CD, you're going to get taxed as you earn that interest.
Okay, so what's another annuity we should be looking out for?
All right, so not to confuse things, but then there's the fixed index annuity. And a fixed index annuity is quite different from a fixed annuity. Now, like the fixed annuity, a fixed index annuity is not in the market. Your money is not in the market, just like it's not in the market with a fixed annuity. But the main difference is that the way you're getting credited is dependent on an index that you choose. So the insurance company will offer you a choice of, do you want this index to compare to or this index? So they might offer you the S&P 500, they might offer you the NASDAQ, or they may offer you indexes that you've never heard of. But the point here is that however that index grows over the period of time, usually a year, that's how you're going to get credited. So if, let's say it's the S&P 500. So from point A to point B, point A would be the time you opened up that contract, and point B would be a year later. So over that period of a year, how did that index do? How did the S&P do? Did it grow by 10%? Did it grow by 20%? Did it cave? Did it go down? However it did, That's what you're going to get in credited interest. Now, I say I hesitate because there's a little more to it than that. So for the S&P 500, let's just say that the S&P 500 went up by 22%. Usually, almost always, you're going to get a cap that's going to be stated up front that, yeah, you get the interest that the S&P, rose by, capped at X, capped at 5%, capped at 2%, whatever it is. And in return, the insurance company will say, but we're going to give you a floor of 0. So if the S&P maybe went down by 22%, you're not going to lose money. You just won't get interest that year. If it went up by 22% and your cap was 5, you're only going to get 5. So that's a very simple example of what's called an annual point-to-point crediting method on your index. And there are other crediting methods. That's just one.
Okay.
So another thing I want to say about a fixed index annuity is fees. Okay, so usually there's a fee, but the fee is not for what we've been talking about thus far. The fee is usually for a feature I have not yet talked about. And that feature is a rider that you can add to get lifetime income. So let's say you like this whole idea of what I just described. And eventually what you want is to have income you can't outlive. That's what the annuity you and I talked about in the beginning, a stream of lifetime income.
Right.
So you would tack on this rider that would allow you to turn on income at whatever point in time down the road once you're sufficiently satisfied that you've grown your money to the level that you want. Now you want to start receiving income. Maybe you're retiring and you're not going to be earning money anymore. So you want to start that lifetime income. So that rider that allows you to do that is offered by the fixed index annuity, and it comes with a fee generally around 1%. Some are more, some slightly less, but I've seen 1.2. And that percentage that you're paying is going to come out of your invested money. And I use the word invested. I just want to put a little disclaimer. You're not invested in the market, okay? Money that you purchased the annuity with, that you funded the annuity with. So that interest or that fee is going to come out of that money for the privilege of having this rider that allows you to have guaranteed a lifetime stream of money for you and or your spouse. If you have a spouse and you want it to be on both lives until the day you die, and then it continues until the day that they die. That's what that is. Have I dazed and confused you yet, Wendy?
A little.
Well, from there, it can get a little, it can complicate it, but mostly with regard to the crediting methods. Okay, there's this fancy crediting method and that one. We just talked about a very simple one of the annual point-to-point. Very simple. Also, what other fees could happen? Some annuity companies that are issuing these fixed index annuities are now charging a fee on the different crediting methods. So you want to look for that. Is your crediting method going to be free, or is there going to be a fee attached to that? I also want to say one of the main points of getting this type of annuity is lifetime income, right? And also if you want conservative money, because let's start with that. Why would you even use an annuity? Well, because you want some sort of guarantee, right? You want to earn money, and you're not necessarily willing to lose the money like you could in the market. The market can go down, and generally it comes back up, but maybe you have some money that you just can't wait for it to come back up. And so that's the type of money that you would use for an annuity. Just like you'd put it in a CD, you'd put it in a fixed annuity like I just talked about. Maybe you're willing to cut short some of your growth, like I mentioned the cap, right? You're okay with not getting the full 22% in exchange for not ever losing the money, right? So that's why someone would choose one of these. What happens with these overzealous salespeople is that they're so busy touting these benefits that they get people confused, or maybe it's not even that. Maybe they're just using their own self-interest. You don't want all your money in one type of vehicle, right? It's not everything in moderation. So this is a good vehicle for your conservative money, but you also have to have some growth money. So I don't think, in my view, you should not put all of your money in an annuity or any series of annuities. You should have some growth vehicles in the market. You should have emergency cash that's not in any of these, because let's face it, an annuity, we haven't talked about this yet, but an annuity modifies your liquidity. Remember, we did kind of talk about it. I said there was a surrender charge if you took
Right.
your money out. So you can't have all your money in an annuity, and you shouldn't. And you shouldn't put all of your money in the market. You should have an emergency fund. You should have some here or there. And that's the critical mistake that people make, is they don't work with a certified financial planner that has their best interests at heart and that is devising an overall plan using different vehicles depending on their liquidity needs, their risk assessment or risk tolerance, I should say. And that's where you can get into trouble.
Okay. So, what other kind of annuities do we have a choice to pick from?
The variable annuity. So we talked about a fixed annuity, we talked about a fixed index annuity. Now, those annuities that we just talked about are not in the market. You're looking at an index and seeing, oh, how did it do? Okay, that's what I'm going to get for my credited interest or the guaranteed interest that came with the fixed annuity. But now we're talking about a market vehicle, and that's the variable annuity. So with this type of annuity, you are literally invested in mutual funds in the market. And the wrapper around it is this variable annuity that has all these features. Okay. So this is a registered investment product, whereas the other ones were not. What's the biggest criticism of a variable annuity? It's the fees. Okay. There are a lot of fees, and I'm going to describe what they are. The first fee is the M&E fee, which stands for mortality and expense. So this is the charge that the insurance company is going to assess to cover their insurance risk and expenses. And this is going to be deducted from your actual contract value. And it ranges from 1 to 1.5%. This is the fee they charge to cover themselves if you live longer than they project. That's why they call it mortality and expense, right? Because they have to pay you when you start that income as long as you live and your spouse. So if you live a long, long time, well past whatever was invested, they're on the hook for that. So that's what that fee covers. Then you will see a fee that's associated with those mutual funds that your money's invested in. Now, mutual funds have fees everywhere you go, whether it's in the market, wherever. There's a fee called an expense ratio. But the expense ratios on the mutual funds that are part of a variable annuity are much higher. So those fees are generally around 1%, maybe even a little bit more. Those are still called expense ratios, but they're just more expensive mutual funds. All right. Then there's the fee for the rider for lifetime income, which we already talked about. So this kind of annuity also has a lifetime income rider. And there's going to be a fee for that. So that's going to be around 1%, could be 2%. So add it up, Wendy, you're looking at 3 to 4% for this type of annuity.
Yeah, that's a lot. I mean, usually typically it's like 1 to 2%, right?
Well,
For
expense
most
ratios.
for most investments.
Yeah, if you're just investing in the market, I would argue that your expense ratio should be well less than 1%. That's the type of vehicles we use. I don't like expensive mutual funds for anybody. So yeah, it's quite pricey. So you get those guarantees. You get the lifetime income guarantee. But what guarantee are you getting on the other stuff? You're not getting a guarantee on the sub accounts, the mutual funds. You're not getting a fee on the mortality and expense. I mean, you're getting the lifetime guarantee. Now, people who like variable annuities are going to say, Well, yes, but you can make more money in a variable annuity than you can make in a fixed index annuity because you're in the market and the market has no limit, which is true. However, sometimes the annuity company will dictate to you what you can invest in, what type of mutual funds you can invest in. And they'll say, okay, well, if you want that lifetime rider, then we don't allow you to invest in this and this and this and this. You can only put it in a very conservative set of mutual funds. So you're paying all these fees, but you don't have that growth vehicle that you think you have. And if you really want a growth vehicle, this is probably not for you. Annuities are not designed to give big growth. That's not what they're designed for. They're designed to provide you with a guaranteed stream of lifetime income and conservative growth, not big growth. So if you want growth, this is not for you or not for that type of money.
It's for more of stability.
Right. And let's face it. I mean, you have some money, Wendy, that you probably don't want to invest in the market. You want to make sure it's there for you. Maybe it's your emergency fund. Maybe it's something that I don't know. You've got plans for. Now, if you have plans for in the next, say, year or two, maybe even 3 or 4 years, definitely I wouldn't put it in a variable annuity or a fixed index annuity because you got that liquidity that's been modified. But you could argue that you could put it in a fixed annuity, the first one I talked about, for just a year or two, right? Because maybe you're not planning to use that money for 5 years, but it has to be there for you. Maybe it's for your kids' college education or something. I don't know. But I shouldn't have given that as an example because there are better things to use for your kids' college education than annuities. And I don't want to open that can of worms.
We'll talk about that later.
Yes.
So what other type of annuity is there?
Okay, so that brings us to the single premium immediate annuity. That's a mouthful. Single premium immediate annuity. And what we say here in our industry is SPIA, because we don't like saying single premium immediate annuity, SPIA for short. And so what is a SPIA? This is an annuity that is literally right away taking your lump sum and turning it into an immediate stream of income that you can't outlive for you and your spouse, or just you if you choose to do it that way. There's no growth happening. There's no indexes. There's no crediting. It's simply you hand over whatever lump sum, let's say $200,000 to the insurance company. And in return, they're going to promise to give you this stream of money, this stream of lifetime income that you know up front for the rest of your life, no matter what, guaranteed. And it can be paid monthly, quarterly, annually, however you want. This type of vehicle is irreversible. So you would not do this if you're not sure. You can't say, oh, I changed my mind. Can I have my lump sum back? No, you can for their free look period, which varies by the state. I think here in Texas, it's 20 days. I can't remember. But after that initial free look period, it is not reversible. You can't change your mind. And what we're talking about here is annuitizing your money. Usually there's no fees. So the fee is whatever that money is, right? So if you turned over $200,000 and they give you $5 a year, which would be horrible, you wouldn't sign up for that. But clearly there's a fee for that, right? So it's not an outright fee, but they're making money, right? They're making money depending on how much they're promising you. And of course, there's all these actuaries that are calculating how long you're going to live, because if you live to be 105, that's going to cost them more than if you live to be, 80. And then there are some ifs, ands, and buts. Can you get your money back if let's say you turn over that $200,000 to the life insurance company who's issuing this SPIA, and then 10 days later you die. Okay, so do you get your $200,000 back? You can, but there are different types of options there. And I don't want to muddy the waters and get into too much detail, but there's the cash refund and period certain. And so there's different ways of how you would get that money back in that scenario.
So what happens if you move? Does that matter?
So if you move out of the country,
state to state.
oh, No, it should not matter.
Okay. But
In
if you moved
fact,
out of the country, it could
I
be.
don't know. I don't think it would matter there either.
Okay.
Yeah, I mean it's a done deal. So wherever you live now, someone might want to correct me on that and say, well, but the money can't travel to your new country. Well, it could be deposited into your U.S. bank, and then you can figure out a way to get it from your U.S. bank to your bank in Portugal or wherever you're living.
Right. Okay. So there's one final annuity, one type that you want to go over.
Yes. So the only other annuity I want to cover today is very much like the single premium immediate annuity, very much like it, but it's a deferred income annuity. So it's the cousin. So it's instead of turning it on immediately, you're handing over that lump sum in exchange for lifetime income, but you're not turning it on until say 5 years or whatever deferral period you choose. So it's again annuitizing your money. There's no do-overs after that free look period, and you know upfront what it is, and now you have that stream of income.
And is there a benefit to that over the other one?
Okay, so all of these annuities can be annuitized. All of them can. But when I was talking about the lifetime stream of income on the fixed index annuity, we were not talking about annuitizing because that's a whole different thing. The lifetime rider that we're talking about with that annuity, you can turn it on, you can turn it right back off. You can get your money back after the surrender period or before the surrender period if you want to pay a penalty. So those have do-overs, okay? This SPIA and DIA, deferred income annuity, those are you can't change your mind after that initial free look period.
So what's the difference between the SPIA and the DIA then?
The difference between the SPIA and the DIA is the word immediate. The SPIA has the word immediate in it, single premium immediate annuity. I'm turning on the income immediately, like within 30 days. And that's it. You have my money, give me my lifetime income for the rest of my life. It's a done deal. Start the income. With the deferred income annuity or DIA, I'm not starting the income right away. I'm going to defer turning it on for 5 years, and it's going to grow a little bit, but it's a different. It grows not through crediting methods or anything like that. So that's the only difference.
So then it's kind of just giving it a little chance to make a little more money.
Correct.
Okay.
But if you want to make a little more money, there's probably a better way to do it. So I'm not a big fan of the deferred income annuity.
All right. Well, that's a starter course for us.
Yeah.
I'm sure that we could dive more into it. But I think that's good enough for now, right? Let's not confuse us any more than we need to be.
Let's not muddy those waters. Yes, there's more to know. There's more to know. I want to just kind of close out the topic by saying that annuities are not bad. They can work for part of someone's financial plan in moderation. And there is research, Wendy, that people who have predictable income in the form of guaranteed incomes like a pension or an annuity stream are happier. There's research. I'm going to include the link in the show notes.
Okay.
Like everything in life, moderation, education, and I strongly recommend that you don't purchase an annuity without having a full analysis of your entire financial picture within the context of a comprehensive financial plan done by someone who can be trusted, like a CFP, who has to legally put your interests first. And, look, the annuity salesman, I'm sure there are some really good ones. I'm sure there are some really bad ones, but they're not held to a fiduciary standard. So be very careful. And that's why annuities have a bad name.
So how do people get in touch with you if they have more questions, Michelle?
Yeah, so they can reach out. I think the best way is to get on our website, GessnerWealthStrategies.com. There's a contact us form. There's a phone number. Just give us a call, however you want to reach us, and we will be happy to help.
Okay. Well, thank you so much. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time.
Thank you for listening to Retire to a Life You Love with Michelle Gessner from Gessner Wealth Strategies. We hope you were inspired to take steps to your financial freedom as you learned new techniques and strategies for managing your finances. To learn more about how you can improve your financial landscape, Visit our website at www.gessnerwealthstrategies.com. That's GESSNER wealthstrategies.com. Or give Michelle and her team a call at 713-589-6448. And don't forget to click the follow button below to be notified when new episodes are available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Michelle Gessner or Gessner Wealth Strategies. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.